Today we have Amanda. She is the State Manager of Earlypay, an Australia-listed company helping business owners with working capital solutions. Today we'll be discussing in particular invoice financing. Alrighty, thanks Amanda for joining us.
No problem.
Appreciate it. Before we get into it, we'll just start with some basics. If you want to give us a background on what you do, what company you work for, and what your role is, Earlypay.
Yeah, cool. So I'm the State Manager for New South Wales ACT. So my role is really to help with the growth of the region. So it's working with SMEs to provide them with cash injections into the business, predominantly across the invoice finance space. Mm-hmm. So yeah, it's sort of like a mix between a business development manager, but also getting really hands-on with the clients from an operational perspective and ongoing once their facilities are on board.
Yeah, awesome. Do you want to give us a bit of a background on Earlypay, a bit about the company?
Yeah, so we're an ASX listed business. We've been around since 2002, but the funding arm of the business has been around since 2013. We do facilities as low as 20,000 up to as high as sort of your $10 million mark. And we work with a variety of businesses, from your startup businesses all the way through to your sort of larger organisations who still need that working capital support. Mm-hmm. So yeah, we've been around for a while and we're very well versed in the product that we offer. And yeah, that's a little bit about us.
No, awesome. Just for the audience, like we know obviously what invoice financing here, and we're going to dive a lot deeper into it as we go on. But just for the audience, give us a sort of a dumbed down version of what is invoice financing, and why certain businesses should consider taking up this facility if they're facing cash flow issues.
Yeah, so in very basic terms, you have a business that supplies services to another business. Mm-hmm. They raise an invoice for that service, and they're typically raising that invoice on payment terms of some sort. So 30 days, 60 days, 90 days, there's lots of different payment terms that they would agree to. And basically what we're doing is speeding up that cash flow for them. So on the day that they raise an invoice, rather than wait for their customer to pay them, we're advancing them portion of that invoice to help bring cash into the business faster. So we're essentially speeding up the cash flow for them by leveraging their invoices as a piece of security.
Yeah, running a business, how important it is to get money in your account. It's a simple thing, like you think you do a job and you're going to get paid for it. But a lot of industries in particular, they have to wait a certain time frame in order to get paid. And that can hurt the business for cash flow, just for day-to-day operating costs. So it's so important that you're covering that pain point for certain businesses. Do you want to touch on what industries are sort of benefiting mainly from this type of working capital facility?
Yeah, so there's some real key industries for us that we see, but it can work for anyone that supplies to another business on payment terms. But the key ones are businesses that have very big overheads. So it's anything labour-based. So that includes your recruitment businesses, your traffic management, security, some of your cleaning sectors where they've got to pay wages every week, but then they've got to wait for the cash to come in. Your transport and logistics sectors. So again, they've got heavy overheads with fuel, tolls, maintenance, paying drivers, all that sort of stuff. So that's another industry for us. Your wholesale and distribution sector. So again, they've got to pay suppliers for stock, and they need to do that generally in advance of receiving it, but then they're supplying again to customers who are paying them late. And then extension of that would be sort of manufacturing, some of your civil sectors, your wet and dry hire sort of industries. They're sort of the common ones that we see. But as I said, it can be any industry that provides a service to another business.
Perfect. What are some industries where you won't deal with?
Yeah, so there's no blanket rule to say I can't supply a certain industry. It comes down to the type of invoicing that they raise. But typically the construction sector becomes complicated because they supply on progress payments. So it can be anything where they raise an invoice in advance.
And the job's not finished.
The job's not finished. They might supply stock on consignment, so technically they haven't fully delivered the goods. So that can extend beyond construction also to some of your sort of marketing sectors and IT and things like that, where they work off milestones as well. So yeah, anywhere where the work isn't fully completed is where we can't really support the business.
Why?
Because we're 100% reliant on collecting from their customers. And I'm sure we'll get into this, but this is where we get the flexibility of the type of businesses we can lend to. Because we're looking at how strong their customers are and their ability to pay. So wherever we are concerned that the debtor might dispute paying an invoice, or the customer might dispute paying an invoice, we're going to be concerned about our ability to collect in the funds. At the end of the day, our job is to protect the client that we're funding, to ensure that if we advance the money, that we're going to be able to collect it in from their customers. So yeah, wherever we've got vagueness on arguing that a debt is due is where we get concerned.
Yeah, that makes a lot of sense. Obviously, we're sort of the middle person between the customer and the lender, right? So we're having these conversations all the time with the customers, and a lot of the customers that probably need this type of facility are the ones in construction, you know, and waiting on payments. So it is unfortunate that you can't help them, but it does make sense because we're seeing builders fall over every week or so. It's a tough time. The debtor themselves, so the customer in that situation, is considered higher risk. So it's going to make it hard for you guys to get your money back and help the customer in those situations. Is that right?
Yeah, the real unfortunate thing for construction is that typically they'll be supplying to like your larger players in the market, big infrastructure contracts and things like that. And those contracts are very weighted to the customer, not to our client. And so, yeah, collecting in those invoices is really tough. And if I could write construction business, I would write so much
You'll
of it.
be a millionaire.
Yeah. So it's frustrating that we can't support it, but it's because there's things in the contract that aren't in the favour of the client that we would be looking to fund. They're very much in the favour of their customer. And yeah, there's just too much room for dispute 100%. On those invoices.
Actually, I take that back. You know, if you're going to play in that space, it's high risk. So you probably wouldn't be a millionaire. You'll probably be going under.
That's it.
Good, that's good. Back on what I was saying before, you know, we're obviously having these conversations with these customers. We're having a look at their financials, assessing their situation and seeing, you know, what sort of solutions can help them grow and manage their business. There is that negative stigma, you know, and I'm going to tell you that sometimes when we have these conversations with our customers, they have this stigma that, it's too expensive. Don't even talk to me about invoice financing. And we know that it's revolutionized and it's gotten a lot better and it's become sort of a no-brainer for certain types of industries. But do you want to just touch on why that stigma is there and how it's changed over the years to make it more affordable and make it more beneficial for certain businesses?
Years ago, and we're talking a really long time ago, it used to be seen as a finance of last resort. So it was the product that people would go to when they didn't qualify for anything else. So it was often used for businesses that had distress. You know, they had a lot of creditor pressure or they didn't have property or other assets that they could leverage and they didn't have any other option but to look at invoice finance. And because of that risk associated with the clients, the product was typically very expensive. And on the opposite side, there was always this concern that their customers would think that they're in distress because they were accessing this type of product.
Yep, I've heard that one too many times.
Yeah, it has changed dramatically and it's now a very cost-effective product for businesses. And I deal with this question
every day.
Every day. And I spend a lot of time with clients just giving them comfort around how the product works, how to explain it to their customers. But at the end of the day, we're dealing with an accounts department that doesn't really relate directly to the person that they're dealing with.
Yes, people don't realise that.
Yeah, and I think the stigma sort of comes from the fact that with invoice finance, you are a little bit more involved in the client's business and there is an element of, you know, communication with their customers or disclosure to their customers that we exist. And that's what concerns most clients about utilising the product. But if your customer's asking you for 30 days or 45 days or 60 days to pay you, but they want you to provide that service level up front or provide stock up front or whatever the scenario is for your business, I don't understand how those debtors would expect you to be able to do that
100%.
Without some sort of working capital support.
Yeah, definitely.
And so I think a lot of businesses or customers now appreciate that businesses need some sort of working capital solution to help them supply their services. So we just spend a lot of time with the businesses getting them comfortable around the processes, what we actually do as a lender, what communication we have with their customers to make sure that they are comfortable with what we do. And yeah, the stigma really has gone. If we were in the market of upsetting their customers or things like that, we wouldn't have a business.
Yep, that's fair enough.
So from a price point, it's dramatically changed and it is really cost effective compared to some other types of lending in the market, especially when you're not requiring property or any other personal assets to secure the funding.
Yeah. That makes sense. So we'll just take a step back. So I want to just sort of get into the difference in pricing versus when it first started to now, just so the audience understand that it has dramatically dropped and become more cost effective. Can you give us an example of what rates we're sitting at for invoice financing when it was considered last resort versus now?
Yeah, so it's probably sitting at an annual interest rate of somewhere between 20 to 30% per annum. Now our interest rates start as low as 7% per annum. So
that's obviously for a really strong customer.
Yeah,
right?
really strong customer. But even on the maximum end of an interest rate, you're looking at sort of 14% per annum. Yeah, so it's a scale, but compared to what it used to be, it is much more cost effective.
Yeah.
And the thing is as well that you're only paying for the funding for the period in which it's outstanding. So again,
that's important to know.
When the invoicing is turning every, say, 30 days, you're only really paying for that 30-day period. So it is much more cost effective than alternative types of lending in the market.
100%. It's an interesting point that you mentioned that, because people might hear 13, 14% and still say, wow, that's too expensive.
Yeah.
But what people don't realize is you're only paying on what you use and up until it's been paid. So, it might be very cost effective. And a beautiful example is, when we had a deal together and we were workshopping it, it worked out to be sort of 1% of their gross profit. And we'll dive into later on a rough calculation of what the true costing is of an invoice financing on a particular scenario. But on that particular scenario, it worked out to be 1% of their GP. So for this particular transport business, they said, if it's 1% of my GP, but I'm getting my money straight away and I'm able to maintain my business and also scale my business, it's just a no-brainer. It is a small profit margin that they're already operating on, but they're happy to sacrifice that 1% in order to get their money sooner to help survive and help, scale and grow their business. So it's interesting that you raised that,
Yeah, I think scale is the important question as well. Some point to grow your business, there's going to be a cost associated with it. And so you need to just be prepared that to grow, you need working capital. And so, it's a small price to pay in order to grow the business or, keep yourself running at the pace you need to run at.
100%. And, obviously COVID-19 being a hot topic. During COVID, how was business for customers? Obviously, we know some businesses were struggling, but how were you guys in that situation? Did you guys get affected by COVID, or were you turning down customers that you would normally approve that were heavily impacted by COVID? Do you just want to give us a bit of a background on how it was during COVID?
Yeah, so one of the key things about invoice finance compared to other types of lending, again, is that I'm looking at the strength of their customers and their customers' ability to pay them as opposed to our client's business.
Yeah.
So if they had a reduced turnover during COVID, or they might have accrued a little bit of tax debt or something like that during that period, which most businesses did, let's be honest.
Yeah.
We were still able to support them. So we weren't really turning down business during COVID because we were looking at the strength of their customers. The only time we would have been impacted is if one of their customers
obviously was going through
a bad time and we couldn't get comfort around that.
Yep.
But what we're doing in that instance is advising our client and telling our client to be wary, I guess, of what services they want to provide to their customer, because we can see that they might be struggling or not that strong. But no, we weren't turning down business in COVID. We were still writing plenty of business because of that, the fact that we were looking at their customers opposed to our clients. And we really wanted to be seen as a lender who was supporting businesses during a tough time.
That's very interesting that you said that, because a lot of people seeking working capital options, they have this thing in their mind that their financials need to be great. Everything needs to be in order to get the finance. So sometimes people might be struggling with cash flow. However, they know that their paperwork's not all ready, or they might have some tax debt, and they're reluctant because if anyone's going to buy them, it's probably going to be at a very high rate due to those factors. Not a lot of people know that invoice financing comes down to not your business, but the people that you're doing work with. So essentially we call them debtors, but our clients, customers.
Yeah.
And that goes a long way, because if you want to go get an overdraft with a bank or even a second tier or a fintech lender, they're going to look at the trading performance of the business solely. And during those times, it might have been very tough, to demonstrate serviceability on bank statements due to what was happening. So it's interesting to know that you guys look at the customer to a certain degree, but I want to touch on how flexible are you guys when it comes to assessing a business? I know you're doing the assessment on the client's customers. However, where do you draw the line? Because obviously you're going to look at the financials of the business. I want to also touch on exactly what you need from the customer in that instance. And also, where's the line drawn? You mentioned tax debt. How much of a tax debt is okay, we're not going to deal with you because you have X amount of tax there? And profitability wise, if they're showing a loss, will you still consider the customer in those situations? And how big of a loss,
Yeah.
I know it is case by case, but just a broad overview.
So most of the time it comes down to size. There's a big difference in lending $200,000 and lending $5 million.
Yeah.
Very big difference. And so the way we assess a transaction often is based off of the size of the lend and how much money we're putting out the door. So we will deal with businesses with tax debt, and what we're looking at is that client's ability to get out of that tax debt. So we want to see that they're entered into a repayment plan, that repayment plan is achievable, and that the ATO is not going to look to take any action against our client during the period that we're funding them.
Is there like a sort of a threshold? So generally some of the lenders that we deal with in the asset finance space, they'll say, given that it's 10% of the annual turnover and the customer's on a payment plan making their payments, do you guys have a similar thing? Or is it just, if it's on a payment plan, it looks like it's well managed, we'll consider it no matter how big the debt is?
Yeah, there's no hard or fast rule. We don't have that blanket, it has to be 10% or less or turnover.
Yeah.
You know, there is going to be a line if someone's tax debt, it's very clear they can't work their way out of it. Yeah, so there's no set percentage that says, you know, if it's 20% of turnover, 30% of turnover, it's more about, well, what's the forecasting of the business and do you have the ability to actually get out of the debt that you're in? And the ATO typically doesn't provide repayment plans to businesses that can't repay their debt. So
that's a good point.
So typically if the ATO is giving a repayment plan, it's because they're comfortable that the client's got the ability to pay that, and that gives us a lot of comfort. And we'll just make sure that the client is showing us that they're making those ongoing contributions back to the ATO. And often, in order to meet a repayment plan, they need a product like ours to do that, because if they've got a set repayment every month, they can't have that risk of the cash not coming in fast enough to make that repayment, because that then has ramifications on the business, and we understand that. So with Invoice Finance, it's not like other types of lending where there's this blanket credit policy that says it has to fit within this. There are ways that we can be flexible depending on the scenario with the client.
I think that's important for this type of business, right? You know, for asset finance, I love matrix-based lending. I like black and white because we want that confidence and we want that consistency when we're submitting applications. Back in the days when you used to be able to call a credit assessor and say, man, if I give you 5% more deposit, will you do the deal? Come on, they've got a clean finance reference, and then you could sort of negotiate with them. That's moved away. We actually prefer matrix-based lending because we can fit it and we know it's a deal before we submit the deal. But it's very different in this aspect, right? Because having that approach where it's case by case and you're looking deeper into the customer's business to see how you can help them and go through that process, I think is a better approach instead of having it as a set thing, because a lot of people might have a bit more than 10%, for instance, and you know they still might need some options, but they've still got a plan in place to manage it all. And if you guys can look at that and see the forecasting and get a deal for the customer to help them, you know, manage and scale their business, then that's perfect. We obviously have had some customer objections when it comes to invoice financing, and obviously we've gone through this together. But just sharing with the audience, the sort of objections we get for our customers is, number one, it's a lot of work. Okay, it's not as flexible. I've had customers come to me and say, I need someone full-time in my office just to manage this invoice financing facility. It's a nightmare, right? And then we've also had customers say, if I get invoice financing, I'll lose all my customers. They will think I'm going under, which was like, it's a big objection, right? And we've mitigated these in the past, but can we just touch on those objections? And if you want to give us a bit more customer objections that you've had in the past where, you know, you've mitigated them and explained to them, made them feel comfortable, and it's actually working well now and they're using it for their business to help grow and maintain? Yeah,
it absolutely can be a lot of work with under certain products and certain lenders. With us, we've worked very hard to develop a technology platform that takes that admin work away.
Yes, love tech.
Yeah, so one of the biggest pain points for businesses is you have to upload your invoices to us. And if you had 100 customers, that's a lot of work exporting those invoices, uploading them. And then the other side of it is when a customer makes a payment, you then have to pull reports from the lender's system to then go back into your system and allocate payments. And it can be time consuming. So with the technology that we've developed, we can API straight into Xero or MYOB account, right?
Nice.
So the client raises their invoices to their customers like normal. And then we basically just see those invoices once they're raised. So there's no longer that requirement to upload invoices. And then we also do a bank feed back to their accounting platform. So when the customers make payment, they can then go and allocate them off without running reports or anything else. So it is a game changer
Yep.
in terms of the product,
Yep.
in terms of the time frame. And I know you've seen this with your customers that have moved from other lenders over to working
definitely
with
want to
us,
talk about that as
and
well.
the time frames that it saves them.
Yeah.
And there's still an option for businesses that don't use either of those platforms.
Mm-hmm.
But certainly if you're using those platforms, the speed to access funding is super quick.
And you save resources.
Massive, yeah.
Well, that's what tech's supposed to do, right? You
Yeah,
know?
that's right. And you also have the option with us of outsourcing the collections function too if you want to, which then saves you a headcount internally.
Yep.
So there's another cost saving that you can look at if you want to. It's sort of one of those things that's not required unless you want to opt into that. But
it's a great service.
yeah, so there's a lot of benefits to the product now, whereas I completely understand that a few years ago it used to be without the tech.
Yeah.
It did used to be a lot of work for businesses, but that has completely changed. And that software for us gets developed on a regular basis. So we're only making improvements to continue to speed it up for clients.
100%. How involved are you with the tech and the back end on that sort of stuff?
I'm not a developer, that's for sure. But I have to use that tech every day.
Yeah.
And so
you need to know how it works.
I need to know how it
benefits,
works. It's how I do my credit assessment on the client as well, is predominantly through looking at the information that comes through that platform.
Yep.
Yeah, but it's our job to feed back to our development team what our customers are saying and where we can make improvements and those sorts of things.
Yeah, that's very important.
Yeah.
Listen to the customers and adapt and learn and build it how they want it because they're going to be using it. 100%. Back on very interesting points, I want to go back to, that you mentioned that we had an example, right? We had a customer that was at another bank and then they moved all their facilities because of that hiring staff, not wasting resources, but utilizing a lot of resources to make this thing work. Do you want to give us a background on how Earlypay differentiates themselves to the majors, right? And I've seen it, obviously, but just for the audience, we know that you've invested a lot in tech, which has obviously helped with the process for all parties, but obviously the banks haven't really done that, right? And that's where we've been able to win some work for customers that, sure, they were getting a bit cheaper of an interest rate, but they were paying someone a full-time salary to manage it. So it's actually not really cheaper, to be honest. And do you know much about the other banks and what systems they use and how Earlypay differentiates themselves with other lenders in terms of their tech and their software?
Yeah, so with the majors, there's only a couple that play in the invoice finance space, so not all majors do it. There's different product types in invoice financing, and I don't want to go into them because it can get complicated. But the banks offer a particular type of product that is traditionally designed for larger businesses. So the qualification process for a major is much harder. They're a lot less flexible, and they don't have the same internal resources as the non-bank lenders do in terms of the support that you get once the facility is onboarded as well. So some of the key differences between us and a major would be the time frame it takes to put a facility in place. We can do something very quick within a few days, depending on the size, to a couple of weeks, whereas the banks can traditionally take just a couple of weeks to get you a term sheet on the table to see what they can offer. But the key difference is that the majors will typically have a lot of compliance requirements and conditions around the facility around financial performance and things like that.
Yeah. Do the banks take security, or is it just against invoices as well?
No, so the banks will typically try to secure as much as possible. That's just the way they operate. They'll also attempt to have you utilizing all of their products that they have, not just invoice finance. They want your day-to-day business banking, and if you're doing asset finance, they'll probably want a little bit of that as well. And if you've got a home, can we have that too?
Can we have that too? Can we have your banking? It just doesn't stop.
So they're a lot less flexible in terms of what they'll fund, and their criteria is, we were talking before, can we deal with businesses with tax sale? If you're talking to a major, the answer to that is no. Are you profitable? The banks want to see that you're profitable, that you're strong. So their product is only really suited to your higher quality of business, but because they don't have the tech or the internal resources, they expect you to do a lot of reporting. There's a lot of audit requirements on the facility as well. So you have that ongoing audit requirement to give them financial data and things like that so they can continue
which
to
can be
look at the
draining on the
strengths.
customer's end, and cost, if you're going to do constant audits on the customer, they need to get their accountant to, do all these forecasting, and if it's 6-month reviews, financials every 6 months. So all that costs money. Having someone manage the facility, to hire someone costs money. So even though the major banks in certain situations or the top tier lenders might have a slightly cheaper interest rate, it sort of gets outweighed in, I don't know, for me, it's like a no-brainer to work with someone like you because you guys have invested in tech, and we've obviously had some case studies together where customers have just loved the process from transitioning from, you know, a bank to you guys, because you have the systems in place, you have the tech, you have the resources, but you also have that support what comes after when you settle the deal, which is so important. So I can say that hand on heart that, you know, our customers have loved that. I'm just trying to understand why other customers will take a bank option if it's that clear cut. What are some things that you think the banks do well when it comes to invoice financing? Like, is it just the interest rate?
I was going to say it's price.
Yeah, just pricing. Yeah,
it's really price, because invoice finance is one of those products that's designed to grow with you as well. So unlike other types of working capital, the larger your turnover or the larger your invoice and customer base grows, so should your funding. So with a bank, if you want to increase your limit, you've got to go through that entire process again, to get that approved limit, where, you know, with a non-bank lender, it's a much faster and simpler process to do that. So yeah, the banks really, they win when it comes to price, but they also win on size. You know, they can do facilities with, you know, $40-50 million of invoice financing that the smaller players can't do. So really, the banks are good at giving you a nice sharp rate and giving you really, really large facilities.
If you're a gold brick client.
Yeah, if you tick all the boxes for them. And they will have a credit matrix, unlike the non-bank lenders who typically can be more flexible around what the client looks like. The banks will still have that ticker box, can you meet the criteria for our credit department?
Yeah, perfect. I want to touch on all these new lenders that are coming into the space. Now, I'm not going to talk badly about them. We're a big supporter of them. So you've got the likes of Prosper, Shift, On Deck. You know, so they're popping up left, right, and center, right? So they're obviously covering a gap in the market. Yeah. So, you know, unsecured business lending in the past has always been a challenge to business owners because they're not that gold brick customer that the banks want. No tax there, serviceability on historical financials, all that stuff is very hard in this climate. So they've sort of come in and said, we'll lend you 100% of your monthly turnover. We just need bank statements. They've done a really good job. They are very expensive to a degree. What I want to talk about is, are you guys looking to compare against them? It's two different things. You know, we obviously spoken about this before, but you just want to tell the audience, when would it be better, do you reckon, to look at a Shift line of credit or a Prosper unsecured business loan against going through invoice financing? And have you had those conversations with any of your customers where you've assessed their business and you said, look, you know what, maybe invoice financing isn't better suited for you. Maybe you should look at an unsecured business lend or an overdraft with one of these lenders? Yeah,
look, all the time. And in fact, sometimes I'll introduce clients to the likes of a Shift or a Prosper or whoever it is because it's the right solution for them. Or tell the introducer that's brought the deal to us that I think it's more suited to one of those lenders. Those guys are really good if you just need a one-off solution, quick fix. You need that cash injection, you want 50K, you want to just be able to pay it off over a period of time and you know you don't need it for the longer term. That's when their product's really good. Or if you're in a consumer-based market where you don't qualify for our type of lending, they're one of the great options for those sorts of businesses like your hospitality and retail and those sorts of things.
Of course, because you're doing B2B, right?
Yeah. So when invoice financing is better suited to a business is when they need that ongoing working capital, because if you get a 50K lend from an unsecured lender and that money runs out and you need more, that's when it becomes difficult because you may be tapped out with that lender or you have to go through that process again to get more. Whereas invoice finance, it's designed to give you that cash injection ongoing. So if you think you're going to need it for the long term, and when we talked about the industries that typically work with us, it's because they have those constraints every single week or fortnight or month, whatever their sort of cycle of payroll and things are. So those cash injections don't fix the problem long term. They just sort of put a Band-Aid on it. But they can work really well in conjunction with invoice finance. So you can actually look to do a solution where you get your upfront cash from your unsecured lender and then have an invoice finance to supplement it. Because we're very happy to work alongside other lenders. So it's something that you can do in conjunction with each other as well. It's not to say you have to have one or the other. That's fair enough. We had a live example and I thought I'll share it. Is we had a customer that was tossing up between an overdraft and invoice financing facility. It made sense that they needed invoice financing because, like you said, it was continuous, right? It was frequent. They needed it every week, every fortnight, every month, just due to their payment terms with all their customers. It made a lot of sense. But this was one of those customers that had that negative stigma.
So they said to me, look into an overdraft and look into this invoice financing, and we'll just compare and see which option is going to be best suited. So when I was workshopping the overdraft, what I found was no one's going to approve, or I wouldn't say no one, but it's going to be very hard to get an approval for an overdraft above $1 million unsecured, right? It's going to be very tough, even with the likes of these fintech lenders. So we workshopped it. We managed to get him approval of 400K overdraft, but that wasn't going to cut it. We ended up going to you guys and we set them up as a $1.5 million invoice financing facility.
Yep.
Yes, the customer had some stigmas and objections towards invoice financing, but we worked together to mitigate those objections, and now it's working well for their business. But I think that's very important, because if you're going to look at an overdraft, generally it's not going to be approved as much as you probably need versus invoice financing. However, to flip it, the overdraft is a lot more flexible in the sense that you can just, use it as you please. There is a bit more work involved with the invoice financing, but it's just a matter of working through the customer. And it's great that you put them onto those lenders in those situations, because you're putting your customer's best interest at heart, and that's what matters most. The last thing you want to be doing is providing a solution to the customer where it doesn't make sense for their business. And we always turn away business sometimes when we can't help the customer. We don't take them on a ride. So I think that's very important that you do that. And 100%, yeah. A lot of people think, like the invoice finance is expensive, but when you think about it, it's actually not that expensive when you're comparing it to the likes of Prosper and whatnot. So generally, the APRs, between 25 to 35%, even higher with some of the other guys, and so many customers are just signing on the dotted line. They're thriving, all these businesses. And when it comes to invoice financing, I think there's something lacking for the market to understand the costing behind it. So what I wanted to do is I wanted to go into a live example of, and I know it's case by case, but go into a live example of some rough costings of how much it will cost a business owner in terms of implementing invoice financing in their business, because it blew me away when I actually did the numbers and we sat down and did a live example, because you've got the likes at 30% APR, all right, and people are signing on dotted line, no problem, they're getting it settled. But then when you mention invoice financing to them, they still have that negative stigma. So the purpose of this exercise is to show, look, if this facility is utilized correctly, it can actually be a lot more cost effective versus fintech lenders. Might not have the same flexibility, but the flexibility is outweighed because you're getting a higher limit and it's a lot cheaper for you in the long run. So do you want to just give us a brief example of a business looking to get invoice financing and how much it would be rough costing to the customer?
Yeah, so I think one of the things you mentioned before, just to take a quick step back, is that overdrafts, for example, they're flexible because you don't have to pay for them if you don't use them. I think you'll find a lot of the invoice finance lenders have identified that as being one of the pain points for businesses, that they see it as being this constant cost, whether they're using it or not. And so a lot of them have developed, including us, products that are a little bit more flexible, that they're a little bit more pay as you use sort of scenarios. I think the reason people sign on the dotted line to the unsecured lenders is because in their mind their pricing is easy to understand, because it's like, oh, well, I can afford those repayments and that's the repayment per
100%.
month, and I just get that. Whereas when they look at invoice finance, they think, I just don't, there's a couple, if you look at a term sheet, you think there's a couple of different prices.
Yeah, it is hard to understand. Yeah.
I don't quite get it unless we sit with them and go through it, which is what we try to do, just to fully explain it to them. But overall, at the end of the day, if you assume, that your invoicing is 30-day terms, you're only paying for that 30-day period. And if we took a client that was on, say, $1 million facility, sort of average in terms of their strength and quality, you're probably looking at about 1% per 30 days for the product.
It's not bad.
Yeah, it's really not.
Considering you're getting 80% of the money straight away,
Yeah.
and able to pay your ongoing costs, scale your business. 1% of 100,000. Would you say? Sorry, $1 million is 100,000
per annum.
Per annum, yes.
Yeah.
Okay.
Yeah, so you're looking at it per 30 days. Yeah, so it depends on the way that the pricing works, is that you basically are paying based on the funds that you draw. So there'll be like a fee against the invoice or against the funds you draw, and that'll be pretty minimal. And then you really just pay interest on funds drawn. So if a client's ever had an overdraft, it is actually quite similar in terms of how the interest component works.
It's calculated,
It's just that there's a small admin fee on the front,
fee,
which covers the cost for us to basically manage the facility for
them.
them.
Yeah, the ongoing service,
Yeah.
collections, all that stuff.
And the difference is you get a service with the product as well, because we're doing that credit assessment on your customers for you. With some clients, we're doing the collections function for you. So there is added value with that fee that's associated with the invoicing as well. But yeah, over a 30-day period, it's really not that expensive. Even though you have 80% available, you don't have to draw it all. So if you don't need it, you can just leave it sitting there as available funds but not pay any interest on it. You're just paying for what you're utilising at the time.
You said something so interesting the other day when we had a chat about a live scenario. You said if we get this facility secured and the customer is reluctant due to the pricing, they can use the ability that they have funding secure to renegotiate with their customers. And I found that so interesting. So let's just say, for instance, on this example, client had a 60-day payment term with their customer. We've got the facility approved for them. They go back to the customer and say, hey, pay me in 90 days, which gives you a bit more breathing space, and add the additional cost they're paying for the invoice financing to the invoice, and they're sort of getting it for free. And the customer, not in all situations, but some of them might look at that and say, you know what, I'm happy to pay that small surplus knowing that, you know, I've got a bit more breathing space to pay this customer.
Yeah. It's like when you quote a job, for example, if you're like a transport client, you're quoting a particular job and you say, okay, well, here's the cost of the job and this is a cash on delivery structure. So I want you to pay me as soon as the service is completed, or I want you to pay me in 7 days. And this is the cost associated with that. And then you could say to them, but if you wanted to pay me in, say, 45 days from when the invoice is raised, it'll cost you an extra, 1% or 2% of however their margin component works. And that helps offset the cost of the funding. So there is really creative ways that you can set off the cost of your invoice finance facility and make it look like to your customer that you're providing them with an additional service that they weren't getting before. And they may be more likely to give you extra business because the rest of their customers expect to be paid 7 days, and you're comfortable giving them 45-day terms, which is a massive help on their cash flow requirements.
That breathing space.
And then on the opposite side, with businesses who have a lot of suppliers, they may have supplier arrangements where those suppliers let them pay them 45 days or 30 days or whatever the scenario is. But because they're getting the cash early now, they might be able to go to those suppliers and say, hey, if I was to pay you up front, or I was to pay you 7 days after you delivered the goods to me, can I have a better price on the stock that I purchased from you? And often they're able to then reduce the cost with their suppliers as well by bringing down the payment terms that they pay them. So again, you can offset it the opposite way. If you're in that wholesale distribution sector, for example, and it's all about purchasing stock. So
that makes so much
creative
sense.
ways.
How often are you having that conversation with customers? Like when they're umming and ahhing about pricing, and you just give them that live example of a way to sort of mitigate the costing and have that negotiation power with the customers. How many times are you having that conversation with customers, and how many customers are actually going ahead with it, having that conversation and being successful with it?
Depends on who they're supplying services to. So if you're a business that's supplying to Woolworths, you don't have any negotiation power with them when it comes to payment terms or anything else.
Of course.
But if you're a business that's supplying to smaller businesses, that's when this becomes really valuable and the power and the benefit is there. I think I spend a lot of time, and I know the BDMs in the business do as well, asking clients what their pain points are and what their concerns are about getting an invoice finance facility. And so often the conversation will lead to this if it's a price-based concern that they have, where we can say to them, well, what if you were able to do this? And we can actually sit and look at their costs and work out how to mitigate some of that cost and improve their relationships with customers and so on. So it's quite a common conversation that we have. Yeah.
No, it's very interesting. Definitely going to be having those conversations when I'm talking about invoice financing, when they have those objections, because a lot of like business owners, maybe some smart ones wouldn't need you to tell them that. They'll think about it straight away. But a lot of them are just probably not going to think of that straight away because it's pretty genius. And a lot of people might benefit from that, and save a lot of money. Negotiate better terms, which is obviously ideal for a business owner. Just want to touch on the future of invoice financing. Like, can you give us a bit of a background on what you think the industry or the space is going to be in the next 5-10 years? It's so good to see that you guys are investing in your technology and it's paying you dividends. You're winning a lot of work because of that, because your systems are in place. Are you guys going to continue to do that? Where do you see invoice financing in the next 5 to 10 years?
Yeah, so in the Australian market, invoice finance is incredibly underutilised compared to, say, the UK, US and Canadian markets, where every major offers it. It's so universally understood and utilised by so many businesses that here we're just a bit behind, but we're catching up. But I think one of the things is people have used their properties a lot to secure funding, especially with banks and others. And as the property market continues to get harder to enter into, there's going to be a lot more business owners that don't own property and don't want to put personal assets up for funding. And I think they'll be looking at alternative types of lending like ours and like unsecured lending and so on to help support their businesses because they don't have property and they don't want to put it up. And I think, as you said, with the advances of the technology and the flexibility you have around time in business and financial performance and all those things, I think the product's just going to continue to get bigger and larger. And we see that because there's more players entering the market as well. So there's more small players popping up offering invoice finance, and I think that just says that there's a need for the product. So I think, it'll continue to grow, and we're already seeing that because our book typically grows year on year. Yeah,
I don't remember the exact stat, but I saw on LinkedIn the growth of alternative funding in Australia is just skyrocketing.
Yeah.
It's just a lot of these lenders are coming and they're just covering a certain gap in the market, and they're just tackling that gap, and they're very successful. So it just goes to show, I think alternative funding is definitely going to continue to grow, especially if you're thinking outside the box and you're looking at where the major banks are lacking and you're sort of capitalizing on that and implementing it in your business. I think you'll continue to have success. But at the end of the day, technology, all these things to help the business, you always need a person behind it. And I can say hand on heart, Amanda, you're one of the best person I've ever dealt with when it comes to finance in general. I think, you're very knowledgeable, you're very experienced, and the way you treat customers is the way we treat our customers. So thank you for coming onto the podcast. We appreciate your time and we look forward to working more together.
Thank you, and I really appreciate the opportunity.
Awesome. Thanks, Amanda.
Thanks.